Trying to keep up with the markets, the economy.
Yeah.
It can feel like, well, like you're caught in a whirlwind sometimes, right?
Absolutely. There's just so much data, so much noise flying around.
Exactly. And that's why we're here today. We're doing a deep dive for you, taking a specific piece of information and really unpacking it.
And today we've got something quite interesting. It's the latest Informist poll. They surveyed, 30 broking firms?
That's right, 30 firms. And they're looking at the Nifty 50 earnings expectations for the Jan-March quarter, just finished.
So our mission here is to sift through that, figure out what these forecasts really mean for India's top companies, and understand the why behind it all.
Cut through the jargon for you.
Precisely. Bring you the signal, not the static. Now, it's based on an Informist poll, as you said. They looked at 47 of the Nifty 50.
Right, and it's worth mentioning up front, they did exclude a few, didn't they? Adani Enterprises, Bajaj Finserv.
And Tata Consultancy Services, yeah. Mainly because their results were already out or estimates weren't available for the aggregate. Okay, good context. So that sets the stage.
It does. So let's get into it. What's the big picture this poll is painting? Is it good news? Bad news?
Well, the main theme seems to be a slowdown. A continued one, actually.
Oh, okay. Not exactly surprising, maybe, but still.
Yeah, the poll suggests overall Nifty 50 earnings growth is likely to be pretty sluggish. This would be the fourth quarter in a row showing that trend.
Fourth quarter, wow.
And what's really standing out is the expectation of, a further slowdown in this March quarter specifically.
A further slowdown, so it's decelerating even more.
That's what the analysts are suggesting. And it could potentially lead to earnings downgrades down the line.
Right, downgrades. That's the key word investors don't like to hear.
Exactly. So for you listening, the headline isn't just slowdown, it's maybe a shift in perception. Analysts might be starting to see these stocks as, less attractive.
Okay, so what's causing this? What are the main reasons behind this expected dip? What did the poll highlight?
There are a few things. One big one mentioned is mounting uncertainty about the ongoing tariff war and its impact. That's creating a lot of nervousness.
The tariff situation, right? Even if it's not directly India, it has knock-on effects.
Precisely. Then you've got generally weak earnings expectations in several sectors. Plus, interest rates are still high. That pressure hasn't gone away.
So combine all that, and the analysts surveyed are basically saying maybe these stocks aren't as cheap as they looked before, given the rising risks.
That's the implication, yeah. The risk profile is changing.
You mentioned the tariff war. Can we just unpack that a little? How does something like U.S.-China tariffs really hit Indian Nifty 50 companies?
That's a really crucial point. The direct impact on India might be limited. Not many direct tariffs on Indian goods in this specific context.
Right.
But the indirect effects, they're expected to be pretty significant. Valma Institutional Equities actually put a number on it.
Oh, what did they find?
They estimate that about 2/3, like 66%, of Nifty 50 companies' revenue is linked either directly or indirectly to global trade.
2/3. That's huge.
It is. So any wobble in global trade, any uncertainty, even if it starts elsewhere, it ripples through and affects the earnings of these major Indian companies.
So even without direct hits, just the general health of global trade matters immensely. Were any specific sectors highlighted as being particularly vulnerable in the poll?
The poll itself didn't single them out quite like that, but you can infer, right? Sectors with big export components.
Like IT, perhaps. Some
Yeah.
manufacturing.
Exactly. They'd naturally be more sensitive to global demand shifts and trade friction. It's just logical.
It is. It's all connected. Okay, let's get to the actual numbers from this Informist poll. The aggregates for the 47 companies they looked at. What are we talking?
Right, the headline figures. They're expecting a 5% fall in aggregate net profit year on year. That brings it to about INR 1.875 trillion.
A 5% fall in profit.
Okay.
And revenue.
Revenue, they see growing, but only modestly. A 5% year-on-year increase, hitting INR 14.350 trillion.
So profit down, revenue slightly up. Squeezed margins, maybe?
That seems likely. And it's interesting, the report notes different pressures on the top line comparing, say, FY24 and FY25.
How so?
In FY24, it was more about weak exports and low-end consumption struggling. But looking into FY25, the slowdown seems to be hitting BFSI, that's banking and financial services,
Right.
discretionary spending, and even capital expenditure. So the pressure points are shifting a bit.
Interesting. Different areas feeling the pinch now. What about comparing quarter on quarter? Not year on year, but versus the previous December quarter.
Yeah, sequentially, it also looks weaker. The poll suggests a 3% fall in the bottom line compared to the December quarter,
Okay.
and top-line growth is expected at 4% quarter-on-quarter, which, if you remember, in December, revenue was up 6.2% sequentially, and net profit was up nearly 4%.
So, yeah, clear moderation even from just 3 months ago.
Definitely showing signs of slowing momentum.
Okay, so the overall picture is, well, a bit gloomy, or at least cautious. But even in a slowdown, there are usually some sectors doing better than others, right? Any bright spots in this Nifty 50 outlook?
Absolutely. It's not all doom and gloom across the board. The poll does highlight a few areas expected to show some strength. Financial services, but excluding banking, pharmaceuticals, and metals look relatively robust for this quarter.
Okay, interesting. Financial services excluding banks, what's going on there?
Yeah, I think NBFCs and other financial players, they're actually expected to post double-digit growth in both profit and revenue.
Double digits. That's pretty good in this climate. Why them and not banks?
It seems their net interest margins, their NIMs, are holding up better. They're described as being at relatively comfortable levels, unlike the banks, which are seeing more pressure.
Oh, okay.
So for the four finance companies they aggregated, the poll expects total net profit around INR 80.30 billion and revenue up 12% to about INR 658 billion.
Solid numbers.
They are. Though, it's worth noting, Kotak Institutional Equities put out a note sounding a bit cautious on the broader macro lending environment, even with these pockets of strength.
Right, so good performance, but maybe keep an eye on the wider picture. Got it.
What about pharma, often seen as defensive?
Yes, and they're expected to do better than most other sectors here. A few reasons are cited.
Like what?
Stability in U.S. generics pricing, that's a big deal for Indian pharma, plus decent volume growth, and they're still getting benefits from some recent new drug launches.
Makes sense. What are the numbers looking like?
For the three big pharma companies in the Nifty 50 they tracked, aggregate net profit is expected to rise about 9% year-on-year. That's INR 53.64 billion.
And revenue?
Revenue also looking healthy, up about 12% to INR 283 billion. So yeah, pretty solid.
Definitely a bright spot then. Okay, and you mentioned metals. The poll suggested they could be the top performers on profit growth.
That's right. In terms of net profit growth year-on-year, metals are expected to lead the pack.
Really? Why is that? The cumulative net profit for the top three metal companies is forecast to jump. Wait for it, 47% year-on-year.
Wow, 47%. That's huge. What's driving that?
It's mainly down to two things. A rise in steel prices during the period, and importantly, a fall in key input costs, specifically coking coal and iron ore.
Ah, the classic margin expansion story.
Yeah.
Higher prices, lower costs.
Exactly. So profit jumps to INR 74.52 billion. But here's the interesting part. Revenue growth is expected to be much, much lower. Only 1% overall for those three.
Only 1% revenue growth, but a 47% profit jump. That really highlights the cost factor.
It does. And even within that 1% average revenue growth, there's divergence. Hindalco's revenue is seen up 10%.
Okay.
But JSW Steel down 3% and Tata Steel down 6%.
Huh. So very different top-line stories within the sector, but the profit story driven by cost and steel prices seems common.
Seems to be the case, although IDBI Capital Markets has put a neutral view on the sector.
Unusual, despite the strong profit expectations.
Yeah. Their thinking seems to be that while performance is strong, the valuations, the stock prices, might already reflect this good news. So maybe a limited upside from here.
Okay, the classic good news is priced in argument.
Pretty much. They also mentioned the domestic steel price rise was helped by the government's safeguard duty and, of course, those falling input costs we talked about.
Right. Okay, so financial services, ex-banks, pharma, metals are the relative winners. Let's flip the coin. Which sectors are looking like the laggards? Where's the weakness concentrated?
Well, the poll clearly points to a few key areas likely to see earnings pressure or even declines. Banking is a big one, automobiles as well, and oil and gas.
Banking. Okay, that makes sense given what you said about margin pressure earlier.
Yeah.
And they have a huge weight in Nifty 50, right?
Massive, about 44% weightage. So if BFSI as a whole underperforms, it really drags down the overall indexed earnings picture.
And the reasons cited were slower loan growth and those NIM pressures.
Exactly. Continued pressure on net interest margins for the banks is a recurring theme.
So what did the specific aggregate numbers look like for the banks in the poll?
For the 6 major banks they tracked, aggregate net profit is expected to fall by 8% year-on-year, down to INR 565 billion.
An 8% fall? Ouch. revenue.
Revenue is expected to be up, but only by 5%, reaching INR 1.214 trillion.
So again, that profit-lagging revenue growth suggests margin squeeze.
Definitely. And there's a footnote here. InduSin Bank is actually projected to report a net loss.
Oh, really? A loss?
Yeah, about INR 2 billion. If you actually take InduSin out of the calculation,
It makes the rest look a bit better.
a bit, yeah. The sector's net profit fall would be closer to 4%, not 8%, and revenue growth would be 6%, not 5%.
Okay, still a fall, but less severe. What's driving the lower loan growth?
Normal Bang Institutional Equities chimed in on this. They pointed to moderation in credit growth, partly because of stress or maybe just more caution around unsecured loans.
Like personal loans, credit cards?
Exactly. And increased oversight from the RBI is also playing a role. Plus, they mentioned the challenge banks face in growing deposits, particularly cheaper CASA deposits. Most growth is coming from pricier term deposits.
Right, that deposit challenge has been around for a while. Okay, so significant headwinds for banks. What about autos? You flagged that too.
Yes, the auto sector is expected to see a pretty significant drop in its bottom line.
Why's that? Volume's okay? Or something else?
It's heavily influenced by one company, actually. The forecast includes a potential 58% plunge in Tata Motors' consolidated net profit.
58%. That's massive. That's dragging the whole sector down.
It's certainly the main driver of the aggregate decline, but there are other pressures, too, contracting operating margins across the board.
Why are margins shrinking?
Things like lower operating leverage, basically, not getting as much efficiency from fixed costs. Also, higher raw material costs creeping back in, and just increased competition, especially in passenger vehicles.
Right, competition's fierce there. So the overall sector numbers.
Net profit for the top 6 auto players is expected to fall 34% year-on-year to INR 180 billion. Revenue, though, is projected to grow 6% to INR 2.2 trillion.
Another case of profit falling despite revenue rising. But you said Tata Motors is a big factor?
Huge factor. Similar to the banking story, if you were to exclude Tata Motors from this group,
The picture changes.
dramatically.
Right.
The rest of the sector's bottom line would actually be up 8% and revenue up 11%.
Wow, so Tata Motors' performance is really skewing the average for autos.
Okay.
What about IT? We know TCS results were already out and maybe a bit underwhelming.
Yeah, TCS results kind of set the tone. Revenue up 5%, but net profit actually dipped nearly 2% because of costs.
So is the poll expecting more of the same from the other big IT players?
Pretty much. Largely stagnant growth is the expectation for the IT sector overall. The reason? No major shift in the macro environment yet. Clients are still cautious.
Still waiting for that spending recovery.
Exactly. So for the top 4 IT firms yet to report, the combined net profit is expected to be basically flat, unchanged year-on-year at INR 154 billion. Revenue is seen up about 7% to INR 1.08 trillion.
Flat profit, modest revenue growth, fits the pattern. I know TCS tried to sound optimistic about FY26.
They did, yeah. But the market reaction to their current results was, let's say, somewhat muted initially, didn't spark a huge rally.
Right. Okay, so IT muted, banking and auto-facing headwinds. What about the consumer? FMCG, how's that looking?
Also pretty subdued, I'm afraid. Fast-moving consumer goods earnings growth is expected to be very muted.
Still seeing that split between urban and rural demand.
Seems like it. The commentary mentions weak urban consumption trends and rural demand is improving, but only gradually. No big surge yet.
So what does that mean for the numbers?
Basically, no growth expected in net profit for the top 5 FMCG players. Flat year-on-year at around INR 91 billion. Revenue barely moving either, up just 1% to INR 464 billion.
Oof. Flat profit, 1% revenue growth. It's pretty tepid for FMCG.
It reflects that sluggish consumer sentiment, particularly in cities.
Okay. And the last laggard you mentioned was oil and gas.
Yes. That sector is also projected to see its overall bottom line fall.
Okay. What are the specifics there?
Looking at the aggregate for BPCL, ONGC, and Reliance Industries, net profit is expected to drop 10% year-on-year. Revenue also down slightly by 1%.
A 10% profit fall. Any specific company drivers?
Yeah, the poll anticipates pretty significant net profit declines for BPCL, down around 37%, and ONGC, down 13%. Reliance Industries is also expected to see a smaller drop, about 3%.
Okay, so weakness across the board there too. It really is a mixed bag then, isn't it? Some clear winners, but some major sectors facing real challenges.
Definitely a mixed bag, lots of cross-currents.
Now, the report also mentioned foreign investors, FPIs. How does all this domestic earnings stuff connect with what they've been doing?
Yes, that's a really important link the report makes.
How so?
It basically connects this anticipated slowdown in domestic earnings, plus all the global geopolitical worries we've touched on, to the pretty aggressive selling we've seen from foreign investors really since October last year.
Ah, so the FPI selling isn't happening in a vacuum. It's partly a reaction to this earnings outlook.
That's the argument being made, and the numbers are stark. The Nifty 50 index itself is down over 16% from its peak back in September 2024.
Right.
And look at the FPI flows. October alone saw nearly $11 billion out.
11 billion in 1 month.
And for this whole Jan-March 2025 quarter, FPI's net sold $13.54 billion worth of Indian stocks.
$13.5 billion net sold. How does that compare to before?
Massive contrast. In the same quarter last year, Jan-March 2024, they were net buyers to the tune of $1.36 billion.
Wow. From plus 1.36 billion to the next 13.54 billion. That's a huge swing in sentiment.
It really is. It underlines how that cooling enthusiasm from foreign investors coincides with this period of earnings moderation and global uncertainty.
That really paints a picture of caution, doesn't it? Even with those bright spots we discussed.
It does suggest a more cautious environment overall, yes.
Okay, so bringing this all together then, after diving into this Informist poll, what's the main takeaway, the key message for someone listening?
I think the headline message is definitely this ongoing moderation, the slowdown in earnings growth for India's top companies. That seems clear.
But it's not uniform.
Exactly. That's the crucial second point. It's not across the board. Global factors, sector-specific issues are clearly headwinds for many.
Right.
But you have sectors like financial services, ex-banks, pharma, and metals showing real resilience, even strong growth in some cases, like metals profits.
So you really need to look beneath the surface of the main index number.
Absolutely. It just highlights how important it is to understand the nuances, the dynamics within each sector, and not just react to the headline aggregate figure.
Yeah, the details really matter here. Okay, so for you, our listener, maybe something to think about. Given these expectations, this continued slowdown, and seeing how significantly foreign investors have pulled back, what might that mean for market stability going forward? And maybe for your own investment thinking. It's interesting to consider how that interplay between domestic performance and global sentiment might shape things in the coming months.
Definitely food for thought. It encourages you to keep tracking these trends, maybe even dig into the individual company reports as they land.
Indeed. Well, thanks for taking this deep dive with us today.